Hey everybody, welcome back to the channel. Now what I want to do for you in this video is explain the difference between the cash value in a permanent life insurance policy and the death benefit. Too often people get them confused, so what I want to do is explain what they each are and then explain the confusion and kind of give you some clarity at the end so you know what's what and how do they play a role in a permanent policy, especially a policy designed for infinite banking. All right, so the cash value is the value built up in the policy, and it's a combination of premiums you paid and a compounded interest that's added to those premiums you paid. So when you pay your premium, it goes into two buckets. One, you're paying the cost of the death benefit, so you can get a death benefit when the insured dies. And two, it goes into a bucket to build cash value, which is a savings account. Okay, so that's how I would compare it. I would compare it to a banking account, and the checking account is that account that you're paying the bills for, which is paying for the death benefit. And the savings account portion is where you're putting money aside to build up for a rainy day or whatever. So your cash value is your savings account in a permanent policy. So it's going to build up and it's going to keep compounding as you continue to pay premium and as you gain interest, and interest is being compounded, your cash value is going to grow stronger and stronger and stronger. You can also use your cash value for let's say you wanted to stop paying premium. Your cash value is what you would use, and based on the cash value you have in that account, you can use that and pay up in one shot whatever death benefit you want to buy. So you say, hey, I've paid premiums for 20 years. I don't want to pay premiums till I'm dead. I want to stop paying premiums now and continue to have my policy work. Your cash value is what you would use, and whatever that cash value can buy, the value of insurance that cash value can buy, you can go ahead and purchase it in one shot and have your policy be totally paid up. Okay, so that's the cash value. We'll come back to explaining a little bit more about it and how it works together with death benefit in a second. Now, the death benefit is exactly what it is. It's the amount of money that you're going to get or your beneficiary is going to get when the insured dies. That's the amount of money the insurance company is on the hook for, and your beneficiary is going to get that money when the insured dies, as long as you keep paying the premium. So as long as you pay the premium, that's going to be paid when the person dies, when the insured dies, right? So that's the death benefit. It's really simple. So it's a different figure from the cash value. The cash value is the money that's accumulated in the savings account. The death benefit is the amount of money the insurance company is on the hook for when you die, so you can protect different things, have money for your loved ones. So that's what that's for. That's the purpose of that. And the cash value is going to be less than the death benefit, right? The death benefit is more, right? You're paying for more for insurance to have more money to take care of your income that you're not going to have, or take care of the house, to pay off that, any debts that you have, to take care of your children, to just pass on your wealth. Whatever reason you have that insurance policy for the death benefit plays that role. That's that lump sum of money that your beneficiary is going to get. So that's different from the cash value. Cash value, savings account building up. Death benefit is the amount of money that the insurance company is on the hook for. Now, if you have your policy structured correctly, you can make sure that you're paying less even as you grow older, right? And what you would pay is for your net amount of risk. That's the difference between the death benefit and your cash value. So for example, let's say your death benefit is $500,000. but you have built up $250,000 in cash value over years. Your net amount of risk is $250,000. You're paying for the difference between the death benefit and the cash value. So the insurance company is only on the hook for $250,000. So you're self-insured partially, right? So you're insuring yourself partially with your cash value, right? So that's how you could structure that to make your cost insure. Because if you had to pay for the whole $500,000 off death benefit, it's going to cost you more. So structuring your policy and being strategic in terms of minimizing costs and maximizing cash value growth is very important. Okay, so those are the difference, right? So the cash value, what I've heard somebody done when they explain infinite banking, they said that the death benefit is the collateral for the loans, which is correct, because should the insured or the policy owner dies prior to paying back a loan, it will be subtracted from the death benefit. So if it's $500,000 and they have $100,000 of loan outstanding, the beneficiary will get $400,000 minus any interest on those loans as well. All right, so they're going to take away that $100,000 that's owed plus any interest. All right, so yes, it is collateral. It is collateral for your loan. They're not worried about you paying your loan back or stress you about paying your loan back, because they already are on the hook for your death benefit. So they could just subtract it from that if you don't pay them their loan back. All right. Now, the person also said that you borrow against your death benefit. Now, that part, the person is incorrect. You do not borrow against your death benefit. Even though your death benefit is used for collateral, you do not borrow against your death benefit. You borrow against your cash value. So if your cash value is $100,000, and I'm going to prove this right now, right? If your cash value is $100,000, your death benefit is $500,000. You cannot borrow $400,000, because if that was the case, right? If you were borrowing against your death benefit, you would be able to borrow up to $500,000 or in that range, right? But you cannot. You can only borrow up to your cash value. So it's not your death benefit you're borrowing against. Yes, the death benefit is used as collateral if the loan's not paid back, because they do have to pay that regardless, right? However, you do not borrow against your death benefit. What you are able to leverage is your cash value. So that $100,000 in cash value is what you could borrow up to. Okay? So hopefully that made some sense to you. Hopefully you understand the difference between the cash value and the death benefit. Now, if you do have any questions, feel free to leave it in the comment section. And also, if there's something that you want me to discuss, a topic or something that you don't understand, please let me know in the comments as well. Now, hopefully this was helpful. You can learn more about this because I explain this and a lot more in my book, Get Your Life Together. And I released that this June. It's going to give you information on life insurance, how it works, and also show you how you can use life insurance as a tool for building generational wealth, saving taxes, use for retirement, and transfer your wealth and all that good stuff. I'm going to leave the link so you can get that copy, all right? Now, if you haven't already done so, make sure you subscribe to the channel and hit the notification bell so anytime I'm releasing a video, you're one of the first to be notified about it. Now, if you do like the information, you thought this was valuable, you got to let me know by giving me a like. It really doesn't cost to like. It costs you nothing to like the video. So give me a like, let me know so I can keep giving you more content and giving you more information. And if you think it's valuable enough to share, please go ahead and share it with your friends or family members so they could actually get the information as well. Again, if you have any questions, leave it in the comment section. And until next time, I'll talk to you soon.